Hello and welcome. This is KYC, a brand new show at NDTV Profit. And in this fast-paced world of stock markets, investors are bombarded with information, but what they often lack is a deep, comprehensive understanding of the companies they invest in. KYC, Know Your Company, is a show designed to give you regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every single day. And in this edition of KYC, we take a look at Tata Technologies. Now, Tata Technologies is a company which is very recently listed on the exchanges. And well, while it is a part of the technology sector, its focus essentially has been the automotive space. Now, it is a global engineering and services company and offers products in development and digital solutions. But besides that, as I mentioned, that it's listed just last year on December 1st, 2023. And it's not only is this focus lies in the automotive space, but there are niches that the company has created for itself, and it essentially looks to cater to those specific areas. As far as its revenue breakup is concerned, well, a majority of it comes from the services area, about 78% in fact, and the balance 22% comes from the tech solutions, space. But with that, what we intend to usually do with all the companies that we take up on KYC is we talk about the fundamentals of the company, and based on that, we also take a look at the rating, the kind of performance it has come through. And among the parameters that we can consider, of course, is the income statement, the balance sheet. We also talk about cash flows and how things have panned out. We talk about return ratios, and among the other set of parameters that we also assess the company on, well, the shareholding will be one of them, besides street credentials, dividend payment, as well as street coverage. But for that, we also have with us my colleague Rucha, who's going to join us to give us more insight into the company going forward. So let's, get off the mark and talk about the income statement right at the top. Rucha, thanks for joining in. How have the revenues of the company grown, and how does the profitability look like of the days?
Right, Agam. Thank you so much. I'll first start with from where Tata Technology receives its revenue. Well, majority, that is 78% of its revenue, comes from the services side, and the balance 22% comes from the technology side. Now, talking about revenue, well, the company has clocked around 5,000 crore of revenues in FY24. And if we look at the 3-year CAGR, that is compounded annual growth rate, the revenue has been growing at 21% rate. Well, talking about the EBITDA, because EBITDA is the right way to look at ER&D companies, it clocked around 940 crore of EBITDA in FY24 and 20.7% 3-year CAGR. Lastly, talking about net profits, healthy profits over here, around 25% compounded annual growth rate, as you can see on your screens. 679 crore is the kind of profits that Tata Technologies reported in FY24. So overall, a thumbs up over here is what we could see.
Absolutely. And well, I would say a thumbs up for the balance sheet as well, because they were in a pretty stable space here. The company is debt-free, as is the case with most technology companies. The company has an shareholders' equity of around 81 odd crores and has net cash around nearly 15 crores in its books. This is as on September 2024, but do remember that this is halfway through the year. So naturally, these numbers will look very different towards the end of the year. But as far as the balance sheet is concerned, it's another thumbs up. But how are cash flows looking here, Rucha?
Cash flows, another thumbs up. Cash flow from operations at 86.7 crore. Free cash flows also healthy at 212 crores, but slight bit of downtick as compared to FY23 over here.
All right, and we're moving on to return ratios. We're considering just the return on capital employed, which is a healthy 28%. And, the thumb rule here is that any number over 20 to 25% is considered healthy at the moment. So that's another thumbs up and when it comes to that specific return ratio. But shareholding is, well, it's not exactly most tightly held, Rucha, right?
Right. So largely Tata Motors, which is the promoter, holds around 54% of the share. Domestic institutions and foreign institutions, equal weightage over here, around 4%. 4% each. So not much of concentration from the institution over here, and balance free float at 38% is what we could see.
Right. And moving on, we talk about how the stock has done over the course of the last 1 odd year, because that's how long the stock has been listed for. And while there was a very strong listing for the stock, well, it's come off quite a bit. And well, as you can see, it's massively underperformed not only the benchmark indices, but also the sector itself. And of course, the reason here is that from here on, there is a little bit of temperance when it comes to growth. In fact, there has been no growth over the past, well, 3 to 4 quarters on a sequential basis, which is why we've seen that little bit of underperformance coming in. And as far as dividends concerned, that stands at around 10 rupees per share. Again, not the strongest here, but that's understandable because the company is still in growth phase. So I'm sure that it looks and uses a lot of its cash flows back into the investments. So I would give it a thumbs down only for the kind of returns that we've seen on the share price. But how's the street coverage looking, Rucha?
Bearish stance is what we could see based on the coverage on Bloomberg over here, with 8 sell calls and 4 buy calls and none having a hold call. Return potential largely flat at 0.4%. But let me talk about valuation also, Agam. Thumbs down over here because Tata Technologies based on FY25 PE looks expensive at 54 times the PE ratio versus its direct ER&D competitors like KPIT, LTTS and Tata Elxsi, all trading between 41 to 47 range. So clearly a thumbs down on valuation part.
All right, so there you have it. Well, in general, the company has performed well so far in terms of its fundamentals, but when it comes to street cred, not so much, and valuations do look expensive, especially given that growth for this particular company is still to pick up. So our overall rating based on the 8 parameters that we have used, well, we get a score of about 5 out of 8, which isn't terrible, certainly, but it could be certainly better. But that's as far as the ratings are concerned. Let's also very quickly talk about the strengths and weaknesses of the company along with threats and opportunities. As far as strengths are concerned, well, the company suggests that the order book is healthy. It's witnessing positive momentum, especially in the second half of this financial year. And the weaknesses here are that the revenue growth is primarily driven by the services segment, and it's witnessing a delay in customer decision making. Now, a lot of that could potentially be behind us because of the fact that the US elections are also out of the way, but we're still waiting and watching in terms of how this will eventually convert into a finalization of deal making. But Rucha, what about opportunities and threats?
Right, so in terms of opportunities, the company is seeing strong demand in the digital engineering space, and this includes opportunities in smart manufacturing, digital thread solutions, and especially generative AI, which is actually the talk of the IT town. But let me talk to you about the threats also. A major threat over here is that pure play auto ER&D players like KPIT are eating up the market share. And second most important threat is the acquisition of these small ER&D players by big IT giants, which provide them opportunities of, economies of scale. For example, Infosys had this acquisition of Intech, which is a pure play ER&D company. So this largely poses as a threat, Agam.
All right, Rucha. Well, on that note, thanking you for joining us and taking us through all those financials as well as several other factors with respect to Tata Technologies. Of course, in terms of the returns, it's something that has been lacking, but there are plenty of pros as well. But let's take this conversation and get in an analyst opinion here as well. Well, we have Omkar Tangsale, senior analyst at Vasuki India Fund, who joins us. Omkar, good afternoon. Thanks so much for taking the time out. Firstly, if you could tell us about the niche in which Tata Technologies is present in, that particular subsector, subsegment. I reckon that a lot will depend on the slowdown in global auto sales and with the lack of sentiment coming through. What is your overall assessment when it comes to this particular sector?
Yeah, definitely. I mean, the Tata Technologies primarily, are into the business of the product development of the auto companies and they have the engagement with the auto EMs in terms of electrification and softwareization of the vehicles in terms of the product development thing. So they are involved in embedded system product and different kind of technologies. They are involved in. We believe that the softness that is all coming up in the growth growth is largely because of the maybe year-end spends have been curtailed down through the automobile vehicles, or Tata Technologies is largely dependent on auto segment because it's the largest contributor to the top line. I believe they could not convert that the book or I mean the order pipeline into the billing as the other peers are doing. I mean like KPIT and the Tata Elixir and other companies. But I believe they are laggard in a part of converting deals and their client engagement as of now. But we'll need to wait and watch what exactly is doing. I believe the dependency is quite high, and currently my outlook is that if the macroeconomies persist, the macroeconomies are persist, then there will be a definitely a, lag in terms of growth momentum in the near term. However, for the year end as a whole, my outlook remains still resilient as the year end is likely to penetrate it high as compared to the traditional IT companies.
You know, Omkar, the management says that they don't want to focus too much in terms of diversification. What they want to do is they want to work on the legacy and lineage of their long-term clients that they already have and build on those relations. And if on the way and when on the way they do get more clients, they will continue to hold that sort of strategy going forward. My question then is that in that case, does diversification play a part at all? Is that even important? And secondly, if you could give me an idea of, the kind of, feedback that you are getting when it comes to now decision making, now that the US elections are out of the way.
Yeah, I mean, firstly, I would like to tell you that the diversification is not always helps. It's better in terms of services where it's majority revenue is coming. Your engagement with the client, your client IT spends will help you to generate a business. Once you are getting into the one vertical and you are expanding your horizontals and you are expanding their services, then your dependency is getting high, so you get more business from the same client account. If that is not the case, then you lag the growth and the consistent revenue growth momentum or consistent revenue stream in the future. I believe Tata Technologies as of now is not get successful in getting the deal conversion and the growth momentum that every peer is lagging. So I am not very much focused on on the divergence, but definitely, I mean, your engagement with the clients needs to be done. And it needs to be improved going ahead. So your business is becomes more resilient and client is more depending upon you. In terms of Trump 202 and Trump 2.0, and in terms of North American economy, yes, definitely there are some green shoots. I mean, the BFSI started looking good. Currently, the commentary from the manufacturing side and also on a heavy business cycle, high tech may improve going ahead. So there are definitely some green shoots we can see. We can also see some investment going around on the newer technologies and newer projects that may encourage the technology spends. But definitely, it will take some time, at least 3 months to 6 months time, to capitalize the growth that they have already achieved. Generative AI and the cloud transformation technologies are the two technologies that going to drive the growth as a newer investment is coming into these newer technologies, and we can see a good investment is
Sure.
going around in near term.
Sure. Omkar, point taken. And well, on that note, thanking you for giving us so much more insight with respect to what you make of Tata Technologies as an opportunity going forward. Of course, all eyes will be on the second half of in terms of what the company can come through with respect to growth, which so far has been a little bit of a challenge, but well, things could potentially improve. In fact, I spoke to the management of the company about what could potentially be in store for not just them, but also the sector. This is what they had to say. Listen in.
Well, I think one of the things that it's important to recognize is that whilst growth is tapering, there is still growth. Last year, there was some 14.5 million units sold worldwide. This year, we expect over 16 million EV units sold worldwide.
Right.
And so there still is growth. But there has been some concern, particularly with regard to the elections in Europe and in the US. And I think, fortunately, those things are behind us now.
Right.
There is some clarity in terms of policy direction. And we fully expect the decision-making now to align itself with the transition that's clearly going on in the industry in support of alternative propulsion systems and specifically plug-in hybrids and EVs.
Right. Well, and it's actually heartening to know that there is still growth, even though it's tapering. But, investors in general certainly want a better idea about what Trump 2.0 means for companies like yours. So I'm sure it's early days. He hasn't even taken office yet. But what could you possibly anticipate from this particular political regime?
Well, I think there's a couple of things that are clear. I think one of the policy positions that he's likely to advocate is the repatriation of manufacturing back to the US.
Right.
I think there's clearly going to be tariffs that are positioned with regard to the competition with different parts of the world. I think certainly in the short term that is likely to generate positivity in and around manufacturing in the United States. What happens medium to long term remains to be seen, but we certainly expect over the next 12 to 18 months to have that positivity translate into investment and into decisions.
Right.
And we are certainly in the midst of a number of very encouraging discussions in and around those things.
Right. Warren, to talk about Tata Technologies specifically, over the past 4 quarters, we haven't really seen any sequential growth. So it's been a challenging period for you all. Even as you see some of your large deals come towards the end of the cycle, where does the bulk of the growth come from now, here on?
Well, I think if you look at the aggregate position, one of the things that you have to do is really look at the business at VinFast and the business outside of VinFast.
Yeah.
We've developed 2 electric vehicles for VinFast, VF6 and VF7. Those things are now those products are now being launched into different markets around the world. And as with all new energy vehicle companies, they typically invest in new products, then they wait to see what the market reaction is before they further invest. And so we've seen a runoff of the business at VinFast. But one of the things that we're encouraged by is that we've been able to backfill that runoff with growth outside of that relationship.
Sure.
If you look at last year, our non-VinFast revenues grew by 30% year on year. This year, our non-VinFast revenues will grow in excess of 15%.
Right.
The base effect of VinFast we're now through, and so that continued momentum within other accounts give us good confidence that the second half of this year will be better than the first half of this year.
Right.
And that momentum we expect to fully take us into FY26.
Okay, fair enough. Also in FY24, you had about 60 clients who were in the bracket of $1 to $10 million. And you had about 3 clients who were in the bracket of over $50 million.
Yep.
Are the requirements of these clients different or considerably different? I'm sure there will be a lot of overlap. And do you expect to see a change in their requirements going forward?
Well, somewhat counterintuitively, one of the things that we are committed to strategically is reducing the number of customers that we work with. We want to focus upon top R&D spenders, and we want to focus upon those organizations that we can have very strategic and meaningful relationships with.
Okay.
And what that should afford us the opportunity to do is really intersect with the strategic imperatives of those customers, particularly as it aligns with new products and particularly as it aligns to the digitization of their enterprise.
Right.
And what we're seeing from the over $50 million a year customers, all the way through to the $1 million a year customers, is investments that they are making in us,
Right.
in and around the portfolio of services that we represent. And again, that relates not just to new products, but also, again, to the digitization of the enterprise and investments in new technologies like AI.
Right. So actually, that was in fact my next question, because you do have, a tenured client relationship, and a lot of this is with very strong lineage. So my question then is, it's going to be more about focusing on the clients that you already have, not necessarily, look around and perhaps look to diversify at this point in time.
I think that's absolutely right. One of the things that characterizes the manufacturing industry is the importance of trust.
Right.
When you're given the responsibility to develop a next generation product, you're really being entrusted with the family jewels of that company.
Right.
And so commitment to that customer, particularly over the long term, informs trust and therefore provides the opportunity to really strategically contribute to the competitive position of that organization. And so that's one of the reasons, again, that we are looking to reduce the number of customers that we are focused upon.
Right.
And invest in those relationships, not just in the short term, but in the medium and long term.
Sure, okay. So let's talk about the deal environment currently. The kind of conversations that you're having when it comes to the pipeline, what can you tell us about deal pricing? And I know we're coming out of some challenging times, but are you looking at an improvement in the pricing in which your deals are happening, and the consequence on operating margins then?
Well, if we look at deal pipeline, we did see somewhat of a slowdown, particularly in North America and Europe, in and around the election cycle. We've seen our customers look for clarity in terms of policy.
Right.
And fortunately, we're through that election cycle now, and we're starting to see clarity in terms of what's likely to happen in North America, and what's likely to happen mainland Europe, the UK, and Scandinavia. And certainly over the last couple of months, we've seen improved confidence in terms of investment, and the types of conversations that we are having right now.
Right.
Certainly augur well, not just for Q4, but also for the next fiscal year. So we're very bullish in the context of the next 12 to 18 months.
Right.
And our order book and our pipeline are aligned in support of that.
Right. In your conference call, you also spoke about the reconsiderations your clients are making between EV and hybrid traction. Can you give us a little bit more of a picture there?
Well, I think as EV growth rates are tapering, I think most of our OEM customers are looking to balance their portfolio between legacy powertrains, plug-in hybrids, and EVs.
Right.
And we're seeing plug-in hybrids as very much as a bridging strategy in support of this transition that we are convinced will continue to build.
Right.
From internal combustion engines to EVs. We are absolutely convinced that the pendulum has swung.
Right.
EVs will be the future.
Right.
But in some countries and in some territories where infrastructure is a challenge, where policy is not necessarily aligned in support of EVs just yet,
Right.
we're seeing some organizations look to hedge their bets through investments in plug-in hybrids.
Sure, point taken. Well, in that case, you've also spoken about smart manufacturing opportunities and AI, even, in fact, customer experience enhancement. Can you tell us more about that as well?
Sure. One of the things that I think the entire manufacturing value chain is focused upon is accelerating manufacturing throughput. And one of the things that organizations like ourselves are being asked to do is leverage technology, and specifically AI, ML, and generative AI.
Right.
In support of smart manufacturing initiatives. And the sorts of things that we are doing is leveraging the contribution of sensors and data to make decisions in terms of improving scrap rates.
Right.
We're helping our customers make decisions, again, in terms of optimizing and balancing their manufacturing assets.
Right.
And through that, either save money or accelerate the delivery of product to consumers. And we're seeing that across the board.
Well, there you have it. That's the management of Tata Technologies telling us about what's in store for the company. But with that, that's all that we have for this edition of KYC. But lots more lined up on the other side. Stay tuned to NDTV Profit.